As Indian investors, most of us naturally have bulk of our investments in the Indian market. And that makes sense. India is one of the fastest growing large economies in the world. In spite of various challenges, Indian equities have been a significant wealth creator over the past 25-30 years. And I strongly believe that Indian markets have the potential to create meaningful wealth over the next couple of decades. However, the last 1 to 2 years have been an important learning phase for investors. When everyone was super bullish on India, valuations became stressed. As a result, despite strong fundamentals, Indian equities have underperformed significantly versus global markets over the last 15-16 months. And this phase has highlighted a key risk that often gets ignored. The risk is having 100% exposure to a single geography. See, today India's macro fundamentals are strong, but no economy is immune to periods of volatility, whether it could be due to global events, domestic challenges, or socio-political factors. Hence, if we rely entirely on one market, it exposes our portfolio to risks that are outside our control. Then another aspect to consider is technology. When it comes to technologies like artificial intelligence, advanced computing, robotics, India is way behind US and China. As technology increasingly shapes the productivity, employment, and economic growth, this gap introduces another layer of long-term risk that investors need to be careful of. See, the broader point is simple. Being bullish on India and keeping Indian equity at the core of portfolio makes sense. But from a risk management perspective, some level of global diversification also becomes important. Now, when you think about global diversification, US market is usually the first and obvious choice, and rightly so. US remain the center of global innovation. Almost every major theme in last 20-30 years like internet, smartphone, cloud computing, platform businesses, biotechnology, and now artificial intelligence has been led by US companies. So if you want exposure to global innovation, US market is a no-brainer. But at the same time, it's important to recognize that US is not risk-free. Rising fiscal deficit and gradual shift in the global monetary order could over time create periods of volatility and lower relative returns. That is why it also makes sense to look beyond just India and US. Now the question is, which other global markets offer meaningful diversification? What about China, which already leads in several areas of manufacturing and technology? How do developed markets like Japan or part of Europe fit into the portfolio? Then what about emerging markets such as Taiwan, South Korea, Vietnam, or Mexico? And what about Middle East that is transforming itself from oil major to global business hub? Friends, earlier accessing these markets from India was complicated and expensive. But today, platforms like IND Money have made global investing far more accessible. So in today's video, we'll discuss how you can invest in global markets outside US and what should be the right allocation mix across geography. Alright, let's get started. So the first global market you can explore outside US is China. Today, China is not just a low-cost manufacturer anymore. It's a massive industrial and innovation economy. Be it areas like electric vehicles, batteries, solar, electronics, industrial automation, and even AI hardware. China is already leading and at par with the US. Today, very few companies can scale innovation the way China does. Then another aspect is valuation. Today, Chinese equities are trading at good discount to global peers. Having said this, the biggest challenge with China is not business execution. It is policy and governance risk. Chinese government has absolute power and shareholder returns are not the priority. Plus, there is also a transparency and trust issue. Financial reporting, capital allocation, and minority shareholder protections are weak in China as compared to developed markets. So China has potential, but it comes with higher uncertainty. In case you want to explore the Chinese market for investment, you can explore an ETF called China MSCI ETF on IND Money. Its ticker is MCHI. In fact, before investing, you can see all the details like ETF price movement, market cap breakup, companies within that ETF, and so on. Okay, before investing in global market, you would need to open an account with IND Money. Like I said before, earlier it was very difficult to invest outside India. It required heavy paperwork, bank visits, then transfer charges of 1,000-2,000 per transaction, and the exchange rates were very poor. Thankfully, this has been changed by IND Money. You just have to sign up and create free US stock account and complete your digital KYC. IND Money had made this process seamless and digital. Plus, you get very competitive exchange rates. I've already done a detailed video on how you can open an account with IND Money to invest in the US market. Do watch that video. Next very promising market is Taiwan and South Korea. Taiwan is one of those markets that looks small on the map but sits right at the center of global technology supply chain. The biggest reason investors look at Taiwan is semiconductors. The world today runs on chips. Smartphone, data center, AI, EVs, industrial automation, everything depends on advanced semiconductors. And Taiwan controls the most sophisticated chip manufacturing capabilities with companies like TSMC. Although the challenge with Taiwan is that it is very cycle driven. When global tech demand slows, the entire market can correct sharply. And there's always geopolitical overhang with China, which you can't fully ignore. As far as valuations are concerned, Taiwan's stock market valuations right now is not cheap as compared to historical median. Currently, it is trading at a PE of around 2021 versus historical median of 15-16. If you want exposure in Taiwan market, you can explore Taiwan MSCI ETF on IND Money. Ticker is EWT. Next, you have South Korea. Now, South Korea is slightly different but still deeply linked to global technology and manufacturing cycles. It is dominated by large global exporters like Samsung, SK Hynix, Hyundai and LG, which gives investors exposure to memory chips, consumer electronics, EV supply chain, shipbuilding and advanced manufacturing. Another positive factor is that Korean companies are slowly improving shareholder returns through better capital allocation and corporate governance reform. But the catch is, Korea is also a very cyclical market. Earnings can swing sharply depending on memory chips prices and global demand for electronics. Since their economy is heavily export dependent, global slowdown can impact Korea faster than domestic consumption driven markets like India. South Korean markets have outperformed big time in last 1 year. So valuation wise, South Korea is now trading at a higher P multiple as compared to historical median. If you want exposure in South Korean market, you can explore South Korea MSCI capped ETF on IND Money. Next two options are from developed countries. It's Germany and Switzerland. Now you may argue that Germany and Switzerland are mature economies and their GDP growth is on the lower side. That is a fair point. But when you invest in Switzerland or Germany, you are not investing only in their local economy. You are investing in some of the world's strongest global companies. Take Switzerland. If you buy the Swiss market, you are buying companies like Nestle, which sells food and beverage across the world, or Roche and Novartis, which are global leaders in cancer drugs and biotech, earning most of their revenue from US and emerging market. Even ABB, which is into automation and electrification, benefits when the factories are built anywhere in the world. To invest in Switzerland, you can explore MSCI Switzerland capped iShare on IND Money. Now look at Germany. Its GDP growth may look boring on paper, but companies like Siemens, Volkswagen, BMW, Mercedes, BASF, Allianz, they are not only German dependent businesses, they are global exporters. In a way, investing in Switzerland and Germany is like owning global businesses with European discipline. Strong balance sheet, conservative accounting, global brands and pricing power. To invest in Germany, you can explore Germany MSCI ETF on IND Money. The next country that you can explore is Japan. Now, Japan is a very misunderstood market. Most people, when they hear Japan, they immediately think of low GDP growth, aging population, lost decades, and they stop there. But that's only half the picture. When you invest in Japan, you are not only investing in Japanese GDP growth, you are investing in some of the world's best global businesses. Companies like Toyota, Sony, Keyence, Tokyo Electron, Hitachi, SoftBank, these are not local plays. A large part of their revenue comes from US, China, Europe and emerging markets. Japan is more like a base for global exporters, not a closed domestic economy. Second, corporate Japan is finally changing. For decades, Japanese companies were extremely conservative with too much cash, poor capital allocation, low ROE and zero focus on shareholders. However, now the Tokyo Stock Exchange has been pushing companies to improve ROE, governance, buybacks and dividends. This is a structural change, not a one-year story. However, there are few antitheses. So after decades of underperformance, Japan's stock market has seen a sharp jump in last few years, especially in last 1 year. So now the valuations don't look cheap anymore. After years of underperformance, Japanese markets have re-rated. It means you are no longer buying Japan market at throwaway prices like 5-6 years ago. Having said this, Japan can still be a good alternative to invest outside US. To get exposure in Japanese market, you can explore Japan MSCI ETF on IND Money. Now let's talk about one of the most neglected countries, Middle East. For instance, look at Saudi Arabia. It is no more just about oil. They're trying to structurally transform into tourism, infrastructure, logistics, financial services, entertainment, renewables. Now, Saudi also has one big advantage of huge financial firepower. They have low government debt, massive oil reserve, and sovereign funds backing growth. Now, what are the risks? So, oil cycles still dominate sentiment. Then governance is state heavy and foreign investors have limited comfort on transparency. So, Saudi works best as a small tactical exposure, not a core allocation. To get exposure in Saudi market, you can explore MSCI Saudi Arabia ETF on IND Money. Next, you have Israel. Now, Israel is very different story. This is a deep tech innovation-led economy. Cybersecurity, semiconductors, AI, defense tech, health tech, many global tech companies either acquire Israeli startup or run R&D centers there. So if you want exposure to innovation outside US, Israel is one of the cleanest play. However, the risks are obvious. Geopolitical tension and volatility. So again, allocation should be calculative. To get exposure in Israel market, you can explore MSCI Israel capped iShares on IND Money. Now the most important question is, how much should you allocate outside India and the US? Let's discuss it. Okay, let me be very clear here. Don't go very aggressive on global market and don't chase returns. Global exposure is more about risk management, not return maximization. For most Indian investors, India should remain the core of the portfolio. That does not change at all. So India can comfortably remain around 70 to 75% of the portfolio. US can take another, let's say, 15-20% because of its dominance in innovation, global platform and capital markets. That still leaves a small 5 to 10% allocation for the rest of the world. And this small allocation is where global diversification actually adds value. This 5-10% outside India and US is not about making big bets on one country. It's about reducing the risk. You don't need to be right on every geography. Even if one market underperforms, another may do well. That is the whole point of diversification. Friends, global diversification will not make you rich overnight, but it will significantly reduce the risk of long-term regret. And today, platforms like IND Money have made global investing simple, low cost and accessible. So there is no real structural barrier anymore. One important point here, you don't need to do this through a lump sum investment. Global ETFs can be bought with same long-term discipline you apply in India. Just invest in global ETF via SIP mode with as low as 500 rupee. So the takeaway is simple. India remains the heart of the portfolio, US remains the innovation engine, and a small allocation outside both works like insurance against valuation risk, policy risk, currency risk, and technological disruption. That's the real reason behind global diversification outside India and US market. Okay, let me not stress this video. I would love to know which global market you find most promising outside India and US. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.